Welcome to Iraqi Dinar Update, your go-to source for the latest news, expert insights, and real-time developments on Iraq's currency, economy, and financial reforms. Whether you're a long-time investor or just curious about the dinar, you're in the right place. When considering how much of your currency holdings to exchange when the right moment arrives, often referred to simply as when the time comes, the decision ultimately depends on your personal financial needs, your risk tolerance, your long-term goals, and your belief in the trajectory of the market. It's a decision that combines emotional reasoning, economic forecasting, and practical planning. This is especially true in scenarios involving a speculative currency investment, like the Iraqi dinar or Vietnamese dong, where holders anticipate significant future appreciation due to macroeconomic reforms or currency policy shifts. Many investors approach these moments with a deeply personal strategy, shaped by years of research, speculation, and hope. Initially, for example, one might have resolved to exchange only a modest portion of their holdings, say 10%, while retaining the remaining 90% in anticipation of a gradual rise in value under a floating exchange rate regime. The idea behind this original plan is straightforward: cash in a small amount to cover immediate needs or secure some early gains, but hold on to the majority of the asset in expectation that it will increase in value once the currency begins to float and appreciate naturally on the global market. Floating a currency often leads to increased value if the underlying economy strengthens and global confidence builds. Holding through that float is viewed by many as a potential way to significantly multiply returns. That approach, at first glance, is logical. If you believe a currency will revalue and then continue to rise due to market-driven demand, then holding the bulk of your position seems like a strategic move. The speculative return could be several multiples of your initial investment. You wouldn't want to miss out on that growth just because you acted too quickly or out of fear. So the initial logic says, exchange a small portion, wait, and benefit long-term. Now consider the other approach. You exchange 90%, 9 million dinars, right away, yielding $900,000. You invest that into a conservative portfolio with an average return of 6 to 8% annually. Even without compounding aggressively, that money begins to work for you immediately. If you achieve just 7% annually over 5 years, your $900,000 grows to over $1.25 million, about what you hope to earn from holding the dinars through the float, but without the same currency risk and with actual cash flow potential during that time. Meanwhile, you still hold 1 million dinars in reserve, just in case the currency continues to appreciate. That million becomes your upside hedge, a speculative tail on a largely de-risked position. The deeper you analyze this, the more you see how the value of liquidity, time, and control begins to outweigh the hope of a future value increase. When you exchange early and in greater volume, you shift your position from waiting to acting. You begin using your capital as a tool rather than holding it as a symbol of hope. You move from the realm of speculation to the realm of finance and growth. It's important to recognize that this strategy shift doesn't signal a loss of faith in the long-term potential of the currency. Rather, it reflects a mature understanding of opportunity cost. Money that sits idle, even if it's in a potentially appreciating asset, comes with a cost: the cost of lost time, missed investments, and limited flexibility. The power of investing capital wisely, especially in a market environment where inflation slowly erodes purchasing power, often trumps the psychological comfort of waiting for more. You also have to weigh the emotional burden of holding a speculative asset long-term. Every day, your wealth is technically tied up in something that doesn't generate income. You can't use it as collateral easily. You can't lend against it or trade it easily in other markets. It's a locked asset, potentially valuable, but dormant. Meanwhile, life moves on. Emergencies arise. Opportunities knock. Waiting for a float to fully materialize can leave you in a constant state of almost there, while years pass and your financial mobility remains limited. Compare that to waiting for a currency to float. You have zero control over the pace, trajectory, or global response to that float. You're exposed to political decisions, international pressures, and domestic policy fluctuations. Moreover, if the float does occur and the rate begins to rise slowly, the market will adjust accordingly. Banks, investors, and institutions will anticipate the trend and price it into other assets. You won't necessarily have a special edge just because you held longer. You'll still be subject to market dynamics, taxation, and liquidity constraints. In many cases, You may find it harder to exchange large amounts later if controls are implemented to prevent rapid capital outflow. That's a real risk in post-float scenarios in emerging markets. Therefore, exchanging a larger amount early, say 90%, and turning it into diversified, income-generating capital could result in a more balanced, less stressful financial life. You still maintain speculative upside with the 10% held back, but you've built a foundation with the other 90%. You've moved from high-conviction speculation to strategic capital allocation. This strategy doesn't diminish the belief in the future value of the currency. In fact, it enhances your ability to benefit from it. If the float eventually takes the currency to much higher levels, your remaining holdings still gain value, but you're not relying on that alone. Instead, you're already participating in growth through conventional means. It's also worth considering that revaluation events often come with immediate market reactions, short windows of opportunity where early movers benefit the most. Liquidity spikes briefly, then stabilizes or tightens. Governments may impose controls. Early exchanges may get better rates or fewer barriers. Waiting too long may leave you in a queue or facing new regulations that dampen your returns. In this context, the decision to exchange 90% and invest wisely isn't just a financial move, it's a way to lock in certainty. To turn paper value into tangible, usable capital. To begin a new phase of growth that isn't tied to the timing of others. To reclaim agency in your financial life. So while the initial idea, exchange 10% and wait, makes sense for those who strongly believe in dramatic post-float appreciation, the revised strategy, exchange 90% and put it to work, reflects a more holistic view of wealth. It's about using what you've earned to create the future you want, rather than waiting for the perfect rate that may or may not arrive in time. The conclusion, therefore, is not that one approach is better in all cases, but that the second approach may provide better overall utility and lower risk for more investors. It offers balance, a base of capital to work with, and a tail of speculative upside. It transforms the dream into a plan. And in doing so, it allows you to live with purpose, not just with hope. Thanks for tuning in to Iraqi Dinar Update. If you found this content helpful, be sure to like, subscribe, and hit the notification bell so you never miss a beat on Iraq's evolving financial landscape. Stay informed and stay ready.